Imagine this, you're in a 12% federal marginal tax bracket and you go to do a $50,000 Roth conversion, still keeping yourself well within that 12% marginal tax bracket. But somehow that $50,000 Roth conversion ends up costing nearly 30% in federal income taxes. How exactly is this even possible? Does it even make sense? Well, that's what I'm going to be getting into in today's video. Specifically, I'm going to be going through and helping you to understand how your taxes are actually calculated in retirement, what type of income gets treated first and what gets treated secondly, and how that works. We'll be talking about the 0% long-term capital gain tax bracket and how that interacts with the other income that you may have, including those Roth conversions. And then finally, I will be talking specifically about how you should be thinking about calculating the taxes on those Roth conversions. And this is something that I think many people may misunderstand, how to calculate the taxes on those Roth conversions. So I'll be getting into that. We'll also, by the way, be getting into, if you qualify for it, that senior bonus deduction, because we'll be talking about how that potentially could get phased out. But real quick though, before I get into the content of today's video, my name is Bill Leatherman for MoneyEvolution.com, and I just put together a brand new retirement playbook on Roth conversions. We'll put a link down in the description below for that, but it's going to go through everything that you need to be thinking about in terms of doing these Roth conversions, when they might make sense for you, and all of the other tax traps and triggers that could be triggered by doing those Roth conversions. So let's jump right in. So we're going to be looking at a hypothetical situation here, and we're going to be using a married filing a joint tax return couple, and we're using 2026 income tax figures here. So we're going to look at a couple things. We're going to say right off the bat, this particular couple, they have $50,000 of interest income and $140,000 of long-term capital gains. Of course, this is a very unique situation. Your situation, of course, is going to be different than that, but the reason why I put this particular situation together is so you can understand how these different elements interact with each other. Again, when you can get that 0% long-term capital gain tax treatment, how that works, how interest income works, and even that senior bonus deduction. So they have $50,000 of interest income, $140,000 of long-term capital gain, so $190,000 of total gross income, and we're going to assume here that's going to be your modified adjusted gross income here. They're going to get some deductions. Everybody gets at least a standard deduction, but they're going to get a standard deduction. We're going to assume this particular couple, they're both over the age of 65 here, so the standard deduction for a married couple filing a joint tax return in 2026 is $32,200. And you might know there's also this other senior deduction, something that's been around for several decades here. There's no income phase out for this particular one. It's $1,650 per qualifying individual for a married couple filing a joint tax return. So if they both are over 65, they're going to get $3,300. By the way, if you're a single tax filer, I believe the number for 2026 is $2,050 for a single tax filer for that senior deduction. The senior bonus deduction can be worth up to $6,000 per person over the age of 65. That runs through the end of 2028. But there is going to be a little bit of a phase out here. And so the way the phase out works, it begins at $150,000 for married couples filing a joint tax return. It's half that amount, $75,000 for single tax filers. And then it phases out completely for married couples at $250,000. So at $190,000, we're going to just run the math through that, subtract out the bottom end of the threshold there, $150,000. So they're going to be $40,000 over the threshold, and it's going to get reduced by 6%. So they're going to lose $2,400 of that senior bonus deduction. And that's for each of them. So if they both are getting that $6,000 minus $2,400, that means they're each eligible now, according to their modified adjusted gross income, to get just $3,600 or $7,200 combined. But that's going to give them $42,700 in deductions that's going to come right off the top of their income. This is very important though. You have to understand how the income, or how the IRS stacks up your income. So your ordinary income is going to get stacked up first, and then if you have any preference income, which is going to come predominantly from qualified dividends and long-term capital gains, things you sold that you held for longer than a year, that's going to get stacked on top of that. So that's how that 0% long-term capital gain tax bracket works. So if you have a whole bunch of ordinary income, it may phase you out of that 0% altogether before you even get your first dollar of your preference income added into that. So $50,000 of interest income, that is going to be taxed at your ordinary income tax rate. Your taxable Social Security, any pension income, any earned income, those are all the things that are going to be taxed at ordinary income. Short-term capital gains would also be included in that. So $50,000 of their interest income, and they're going to get to deduct those deductions from that ordinary income. That again gets done first. So that leaves them with $7,300 of ordinary taxable income, and that's going to keep them in the 10% tax bracket. So the tax on that would be just $730 on that ordinary income. For the preference income for 2026, the 0% long-term capital gain and ordinary or qualified dividends can be as high as $98,900 of that preference income and be 0% tax, something that a lot of people don't even really know exists. But we went a little bit over that because we had a little bit of extra income that's that ordinary income. And again, that's going to get subtracted out from how much of that preference income we can get at that 0% rate. So $98,900 minus $7,300 means that $91,600 of that $140,000 long-term capital gain is going to have no taxes applied to that. So their total long-term capital gain was $140,000. Subtracting out the 0% means that we're going to have $48,400 of that preference income that's going to be taxed at 15%. By the way, there is a 20% tax that starts, I think, at about $550,000 or so. So it's way up there. Most people are probably going to be either at that 0 or 15%. So the taxes on that preference income is going to be $7,260. And then our total tax, when we add in the $730 from that ordinary income that was taxable, the tax on this whole $190,000 of gross income is only $7,990. And that means our effective tax rate is just 4.2%. And this is important because as you start to work out your retirement plans, you start to plan out your withdrawals, which accounts you're taking money from first, whether or not you're doing any Roth conversions. You know, if you think about it, while you're working, if you're in a 24 or a 32% or a 35%, 37% tax bracket, you do Roth conversions, you're paying taxes at that higher rate. That's your marginal tax bracket. But in retirement, we need to look at how we're distributing those assets, and that effective tax rate is going to be very, very important here. So let's take our same example here, and the only thing different that we're going to do is we're going to add in a $50,000 Roth conversion here. So now our ordinary income is going to be that $50,000 of the interest income, but that Roth conversion is also going to be considered ordinary income. By the way, I didn't mention it, but any withdrawals from a traditional retirement account, 401k or IRA, that's also considered part of your ordinary income as well. So now they have $100,000 of ordinary income, and they still have that $140,000 long-term capital gain. So their modified adjusted gross income, or their gross income at the top, is going to be $240,000. So now let's look at their deductions. The $32,200 standard deduction, the regular senior deduction, those are not going to change. But now that senior bonus deduction is going to get phased out here quite a bit. At $240,000 of modified adjusted gross income, they're going to be right up at the top of that phase out range, which gets completely phased out at $250,000. So the way we're going to calculate that, the same way, that $240,000 of modified adjusted gross income minus our bottom end of the threshold, $150,000, another $90,000 over the threshold. So $90,000 times 6% is a $5,400 reduction per individual, which means they're only going to be left with $600 each, or $1,200. So now their deductions that they get to take off of the income have changed significantly, now down to $36,700. So let's talk about how the ordinary income piece is calculated, because again, that's done first. So $100,000 of ordinary income minus our deductions means that $63,300 is going to be taxable ordinary income. The top end of the 10% range for a married couple filing a joint tax return is $24,800, which means that they're going to have about $38,500 that's going to get hit into that 12% bracket. By the way, there's still a lot more room left in that bracket. I think they're about halfway through that 12% bracket in this example here. And if you're a single tax filer, for the first three brackets, I think, or 4 brackets, the rates in the tax tables are going to be just basically about half of what they are for a married couple filing a joint tax return. So now the taxes on the ordinary income is going to be $7,100. Now let's look at the preference income. So again, that $98,900, that's the top end of where the taxes would be zero on that preference income, minus how far we went into that. So we had $63,000 of ordinary income. Remember, that gets subtracted from the amount of that 0% marginal tax bracket we have for preference income, which means that only $35,600 of that is now going to be taxable. The rest of that is going to be taxed at 15%. So $140,000 minus the amount that was taxed at the 0% tax bracket means $104,400 is going to be taxed at 15%. So $15,660 is the tax. And when we add all that up together, we have ordinary income tax of $7,100 and then that preference tax of $15,660. So now our total tax in this example is $22,760 versus only $7,990 if we didn't do the Roth conversion. So that's a difference of $14,770. So one of the things that I'm a big believer in is anytime we're exploring different tax scenarios, we always want to look at what is happening at the margin. So in other words, we want to create a scenario A and a scenario B and look at what would our taxes have been under scenario A if we didn't do whatever it is we're talking about doing, whether that's a extra distribution from an IRA account, or it's a Roth conversion, or it's selling some stock, or whatever it may be. We always want to look at what is happening at the margins here. And in this case right here, the only difference between these two scenarios, A and B, was we did a $50,000 Roth conversion in the second example. So if we're effectively paying $14,000 more in taxes, $14,770, we divide that out by how much we did as a Roth conversion, and that Roth conversion of $50,000 actually cost 29.5%. So that's something that a lot of people may be missing out on as you're doing some of these Roth conversion calculations and understanding what is that real tax cost if you do that Roth conversion. I just did this by hand just so you can see how this works. In the software we use for our financial planning, the software does that for us. So we can very quickly run through multiple scenarios and look at different Roth conversions, different amounts, see how it looks to spread them out over a number of years, how that interacts with the other income that you're going to have, because as I always say in most of my videos, is goal number one is, is there enough money for you to do what you want to do in retirement? Are you covering your basic expenses? And that income is going to get stacked up first before you do any Roth conversions, because that's all done, again, at the margins. But getting the income for your retirement needs and expenses is going to be goal number one. So one more thing here, and again, this is one of these tax triggers that gets hit because our modified adjusted gross income was now $240,000. We're actually going to be over what that IRMAA limit is. IRMAA is the income related monthly adjustment amount for the Medicare surcharges if you're over certain thresholds there. So $218,000 is what that is for 2026. What that means is that for this hypothetical couple, they're going to be paying $100 more per month each for their Medicare costs. So that's going to be $2,400 a year. So if we added that in there and said, okay, now instead of having $14,770 in tax, IRMAA is not really a tax. Sometimes I refer to it, and other people do, as a stealth tax, but that gets added in there as well. So now that means that their effective tax rate, including that IRMAA surcharge, is now 34.34%. So something to be very careful about as you're doing these Roth conversions, and make sure you understand all of the different math. And again, I think the best way to do that is to have some type of a piece of software that you can use, because what might make sense for you to do as a Roth conversion in this year, in 2026, you want to look and explore, what does that look like down the road? Are you actually saving taxes 5, 10, 15, 20 years down the road, and is it having a positive impact as you do these Roth conversions? So we love Roth conversions. I would say 95% of all of our clients that we do financial planning for, they end up doing some Roth conversions at some point, but I think a lot of times people may overdo some of these Roth conversions and end up having a situation like this where you could get hit with a lot higher tax. Now, how could this be avoided? Well, one of the ways that this could be avoided was to obviously skip that Roth conversion for this year, or maybe try to plan out our income a little bit better. So in some years, maybe we want to focus more heavily on doing that 0% long-term capital gains. We want to sell some assets that are going to bring in some money, and hopefully we can hit the majority of that maybe at that 0% long-term capital gain tax bracket. Maybe we can build a little bit of a cash reserve stockpile if we have the right combination of stock value or position value relative to the cost basis on that. And then other years, we could just go more heavily towards doing those Roth conversions so that we're not stacking up that preference income at the same time as we're doing the Roth conversions. Now, for some people, it makes sense, depending on how much money you have in those traditional retirement accounts. Sometimes it makes sense still to do both of these in the same year, even if it does cause your IRMAA to go up in cost for that, or maybe even hit a higher tax bracket because of the value you have. But that's generally going to come in where we start to see IRA balances that are going to be minimum of $2 million, maybe $3, $4, $5 million is where we have to start getting a lot more aggressive. The other factor that's going to be in here too is how much time do you have before those required minimum distributions kick in, and is there some low tax years potentially where maybe like this couple right here, we assume that they weren't taking their Social Security benefits yet. So anyway, I hope this video has been helpful. Don't forget to hit the subscribe on the channel. Check out some of those free resources that we have. We have the Roth Conversion Playbook. That's our newest one. We're going to be launching a few more of these. They're in the pipeline right now. The last one we did, which was about a month ago, was the Retirement Tax Planning Playbook, and that talked about some different strategies of things that you can do before retirement, and especially in that early part of retirement. So check all of those out. Check out moneyevolution.com, and I look forward to seeing you back in one of our next videos.